It is 2 a.m., your brain is fried, and the TV is still on. A commercial comes on with dramatic music, flashing red graphics, and a guy in a suit telling you the dollar is collapsing. Protect your family, buy gold now. And if you have ever been stressed about money, that message lands like a punch. So average Dave does exactly what the commercial wants. He grabs his phone, dials the number, and buys a heavy safe full of gold bars. A week later, the safe shows up. Dave locks it, sits on it like a dragon, and finally exhales. I'm secure now. Fast forward 10 years, Dave opens the safe. The gold looks exactly the same. Same shine, same weight, same cold metal. He takes it to sell, and the result is underwhelming. It buys him roughly the same amount of real life it would have 10 years ago. Not nothing, but no real leap forward, no lifestyle upgrade, no freedom, no escape velocity. And that is when I walk in, lean on the safe, and tap the gold bar. Dave just bought the oldest financial lie on television. He thought he was investing, but he mostly bought a shiny pet rock. Today we are going to look at the brutal math of gold versus the S&P 500. And why billionaires buy businesses, not bullion. Quick disclaimer. This is education, not personal investing advice. All investing involves risk, including stocks and commodities. Now let's start with the only difference that matters: productive assets versus dead assets. A dead asset just sits there. A productive asset produces something. Warren Buffett said it in the simplest way possible. If you buy an ounce of gold today and hold it for 100 years, at the end of that century, you still just have 1 ounce of gold. It does not breed. It does not pay you rent. It does not ship products. It does not hire workers. It does not invent new things. It just sits. Now compare that to stocks. A stock is not a lottery ticket. It is a piece of a living, breathing business. That business sells products, raises prices over time, adapts to inflation, cuts costs, expands into new markets, and when it is profitable, returns money to owners, sometimes through dividends, sometimes through buybacks, sometimes through growth that increases the value of the business. So when people argue gold versus stocks, they are not comparing two equal things. They are comparing an insurance-like store of value to an engine of value creation. And you do not get rich buying insurance. You get rich owning productive assets. Now, does that mean gold is useless? No, gold can have a role, especially as a hedge or as a small insurance policy. But the gold industry does not sell it that way. The doomsday marketers sell gold like it is the path to wealth, and that is where people get trapped. They buy fear, and they miss compounding. So let's break down the 3 main reasons stocks tend to win over long time periods, and the hidden costs that make physical gold worse than people expect. First, the inflation myth, preservation versus growth. You have heard this line: gold makes you rich when inflation hits. Here is the more accurate sentence: gold often preserves purchasing power over very long time periods, meaning it can help you keep what you already have. But preserving wealth is not the same as creating wealth. A simple way to visualize this is an old comparison people use. In the 1920s, a gold coin could buy a nice custom-tailored suit. Today, that same amount of gold can still buy a nice custom-tailored suit. That is impressive in one way, because it means gold can keep pace with long-term purchasing power. But notice what did not happen. You did not upgrade from a suit to a house. You did not go from a suit to financial independence. You stayed in place. So gold is not nothing, but it is not a wealth escalator. It is a wealth freezer, and freezing wealth can be useful, but it is not how you build a life where work becomes optional. Stocks, on the other hand, are not trying to preserve only. Stocks are trying to grow. Businesses increase productivity, increase output, innovate, and attempt to earn more over time. So when inflation rises, businesses often raise prices. Not perfectly, not instantly, and not every business survives, but as a system, productive assets adapt. That is why over long periods, broad stock markets have historically outpaced inflation. Second, the compounding engine, dividends. When you own stocks, some companies pay dividends, a share of profits, and if you reinvest those dividends, you buy more shares. More shares can produce more dividends. That is a snowball. It is not magic. It is multiplication through time. Even if dividends are not huge in any single year, reinvestment compounds over decades. Gold pays no dividends. Gold does not send you a check. Gold does not pay you rent for holding it. You only make money if someone later pays more for your metal than you paid. That is it. So gold investing often becomes a game of greater fool. Not always. Sometimes macro forces drive price. But the mechanism is still resale-based. Stocks do not require a greater fool in the same way because the underlying business can produce cash and value. You can have shareholders earning returns even if the story is not exciting, because profit is real. Here is a quick question. If gold is the ultimate wealth builder, why do the richest families on earth not store their wealth mostly in gold bars? Why do they own companies, land, factories, and cash-flowing assets? Because they understand the difference between a rock and a machine. Third, the fear tax, the hidden costs of physical gold. Physical gold is not free to buy and not free to hold. When you buy physical gold from a dealer, you often pay a premium over spot price. Sometimes it is small. Sometimes it is huge. Depending on the product, the dealer, and how panicked the customer is. In those fear-based commercials, the spreads can be brutal. It is common to see markups in the range of 5 to 10%, sometimes more, especially on collectible coins pitched as special. Meaning, you can start the investment down immediately. Then you have storage, a safe, a bank deposit box, insurance, maybe extra security, so you are paying ongoing costs. To protect an asset that is not paying you anything, that is the definition of a liability. And this is where the gold marketing gets sneaky. They show you charts. They show you fear. They show you collapse scenarios. They rarely show you the premium you pay on day one, plus the storage costs, plus the hassle of selling later. With stocks, especially in low-cost index funds, the friction can be much lower. Again, nothing is free and markets are risky, but you are not paying a 5 to 10% dealer spread and then locking it in a safe. So if you are buying gold as insurance, you need to be honest. Insurance costs money. The problem is when people buy insurance thinking it is a growth strategy. Now let's put this into a long race. A comparison that makes the difference obvious. We go back 50 years. Two friends each have $10,000. Gold Gary puts $10,000 into physical gold. Stock market Sam puts $10,000 into the S&P 500 and reinvests dividends. I am going to say this clearly. This is an illustration. Exact results depend on the start year, end year, fees, taxes, and what exact gold product you bought. The point is the magnitude of the difference between preservation and compounding. After about 50 years, Gary's gold becomes a respectable number. In one example scenario, it might grow to around $350,000. That is not nothing. Gary protected purchasing power and likely beat inflation over that stretch. Gary feels okay. Now Sam. Sam's diversified stock index investment, with dividends reinvested, can grow to well over $1.5 million over that kind of time horizon, based on historical total return patterns. So Gary protected his money from the apocalypse in his head. Sam actually got rich in the real world. That is the entire argument. Gold can preserve, stocks can compound, insurance can stabilize, engines can grow. And you do not build wealth with stabilization alone, you build it with productive ownership. Now before someone says, yeah, but what if the stock market collapses? Let's talk about what that fear really is. Gold commercials are selling a movie plot: total collapse, currency death, society chaos, and look, anything is possible. History has ugly chapters, but ask yourself this: if society truly collapses, do you think your biggest problem is whether your gold went up? Or is your biggest problem food, water, security, community, and location? In a real collapse scenario, physical gold may not be the king people imagine it is. And in normal scenarios, the scenario we actually live in most of the time, the thing that tends to win is productivity. Businesses adapt, people keep buying, innovation continues, and ownership compounds. So what is the practical takeaway? Gold is a shiny insurance policy that can preserve wealth. Stocks are a living engine that can create wealth. You do not get rich buying insurance. You get rich owning productive assets. There is nothing wrong with owning a little gold as an insurance policy, if you understand it as insurance and not as a retirement plan. But you do not build a house out of insurance policies. You build it with bricks, businesses, and compound interest. So if you feel pulled toward gold because you are anxious, Do this simple reframe. Do not ask, is gold good or bad? Ask, what job am I hiring this asset to do? If you want preservation, a small allocation to gold might fit your personal comfort. If you want growth, long-term wealth building, the historical engine has been productive assets, broadly diversified. And if you are buying physical gold because a commercial scared you at midnight, you are probably paying the fear tax. Now let's summarize. Gold is a dead asset. It does not produce cash flow. It mainly preserves purchasing power over long periods. Stocks are productive assets. They represent businesses that generate profit, and profit can compound through reinvestment. Physical gold carries hidden costs, dealer premiums, spreads, storage, insurance, and it has no internal compounding mechanism. Final thought. Fear is expensive. Doomsday marketers are not selling you safety. They are selling you urgency, and urgency is how you overpay. If you want to stop investing out of fear and start investing with math, subscribe, and let's build that portfolio with a strategy designed for the world we actually live in. And tell me in the comments, what is your main reason for wanting gold? Inflation, fear of collapse, diversification, or just curiosity?